That's a tough one. I don't think there's a whole lot that's really exciting to be at this point. Like I think equities are a high risk play. They're still in an uptrend. We're still long stocks, but the market is definitely showing signs of weakness and fatigue. Typically, when we see gold and silver do this type of price action, it means we're very close to an economic top, something big, and that'll obviously send equities lower as well. And precious metals I'm scaling out of. I think the play to me is to protect your capital. And sometimes to do that, you just have to step aside. So move to cash till there's a new trend. The charts just whisper to me. They just kind of tell me what's going on. No, but the charts were pointing to this. So when you and I spoke last, I talked about how 106 was my measured Fibonacci target. Typically, once you hit that, if we can break through it, we're going to go into some parabolic emotional phase where it could blow up to 120, 130, 140. And that's pretty much exactly what happened. I was in Vancouver at the VRIC event and it broke through 106 and it spiked to pretty much 120. And everybody kind of went ballistic. The energy in the air was pretty wild. But that's typical price action. When there is a mass kind of herd psychology play where a lot of people are piling into a sector because it's been hot for long enough that people are all aware of it, we tend to see these strong explosive moves. And they're fairly predictable. Like the charts paint a very clear picture of where momentum should take us, which is 106. But once you break through a Fibonacci target, is I call an invisible ceiling. Once you break through this invisible ceiling, you kind of pop into no man's land, a bit of a bubble territory, right? And we've seen the same with gold. It's happened twice over the past year where you hit this target and then it pops and everybody gets excited. So that's what we've seen in silver. And the pullback, I mean, I think we could see a 40 to 60% pullback in silver. We saw a 32% pullback from the high in one day, which is pretty wild. But that's not the type of pullback I'm actually looking for. I'm expecting we're still going to get a bigger pullback in metals. It's going to take several months to unfold because I think the equities market is very close to a peak here and it'll drag the markets down. But short-term wise, when we look at the charts, Elijah, the market the way silver moves is a little bit kind of like a meme stock, like GME and things like that, where everybody piles in, they drive the price to kind of short-term ludicrous kind of pricing. And of course, everybody piles in and then there's a mass exodus when they all leave. They all bail out very quickly. Now, silver is obviously a futures market. So futures and margin calls kick in very quickly, which is what I think happened on that day. There's a ton of margin calls, huge volume. Generally, a commodity doesn't move 32% in a day. So, as soon as you apply leverage to that, I think people with leveraged accounts, leveraged ETF trades on silver, who are trading futures on silver, there was just a lot of forced liquidation. And you could see it on the intraday chart. You could just see the volume picking up and the waterfall sell off, like on the 10-minute chart, just going off a cliff. So I think now we could get a bounce. There's a lot of selling pressure. Still, people are still in shock. They're trying to digest that move. But I do think we're going to see silver and gold get bought back up here, and potentially silver works its way back to up to 100, maybe even gets back to 110 here. So it's really going to come over the next couple of days. How is this sentiment going to stabilize? But I am still bullish. I do think it's going to get bought up and see as a bargain here for a lot of people. So if we take a look at the chart here. We got the chart of silver. This is the daily chart. You can see how it takes the staircase up and then the elevator down. That is typical price action. I mean, it's a huge move, but this is what happens when we get into kind of a euphoric kind of phase in something where people just don't care what they pay anymore. They just want in. And that's kind of what we saw. We had a target here at 106. And then, of course, it blew all the way up to 121, and then it fell all the way back down to 72. So when we look at this chart, I believe it still may be under pressure for a few more bars. It might take a little bit more time for a lot of investors who are nervous to keep selling out, and it's going to keep some downward pressure. But I do think we're going to see this kind of work itself back up to the 100 mark, maybe even push up even higher before maybe it goes into a bigger correction. So that's what I'm trying to get a gauge on right now. The charts now have cleansed the air. We've definitely seen some damage done, and now we just need to see how this is going to unfold. And again, I think we're going to see some bargain hunters step in, and it's going to find support here.
What followed was equally textbook. Leverage magnifies both sides of a trade, and silver is one of the most leveraged markets on Earth. When prices began to roll over, margin calls triggered forced selling across futures, ETFs, and short-term speculative accounts. The result was a rapid waterfall-style decline rarely seen in physical commodities. This wasn't investors calmly exiting, it was mechanical liquidation. High volume confirmed panic, not decision-making. These sharp corrections feel dramatic, but historically they are how overheated markets reset after euphoric advances.
I don't believe this. This is where I think a lot of people are going to get caught off guard. I think people are going to think now that, the 20% pullback in gold in like a couple trading sessions, the 32% pullback in silver. I think people think that was the crash. And I don't believe that was the crash. In fact, metals, I think, could still potentially even push higher. So if we look at these two charts here, this candlestick chart on the left-hand side is the S&P 500 when it hit all-time highs. And then it put in a peak and started to struggle a little bit. The yellow line is the chart of gold. And if we take a look at the right-hand side, we've got the S&P 500 hitting all-time highs, and then the yellow line is gold. And what we've only seen is really just a pullback, a blip. We still could see metals go higher. And if we were to just scroll forward on 2007 chart, notice the candlestick chart down below. The stock market starts to sell off. The money comes out of this equities market and it shoots into gold, silver, platinum, and palladium and sends it sharply higher. So I believe we could actually still see that. Bull markets are always trying to buck people off. The pullback in gold and silver, you could argue, is still just a buck. Like, we could go back to gold, and we've seen this before. When we came over here, this was earlier. This was in October of last year. We saw gold have the very similar move. It took off. It hit our 100% measured move right here, which is where we closed out a short-term position. And then it went into this euphoric kind of blow-off phase. And then, of course, it got hit very hard. And a lot of people thought that was the peak. They're like, okay, it is now reversed. But all it did was anybody who's late chasing it put them through this roller coaster ride. It restabilized and it came all the way up. We actually closed out our gold position here on the 28th because it hit our 100% measured move. Gold had the blow off top, just like silver, and now it's correcting again. So gold and silver really are doing kind of these. They're both the same. They have a big run up, then they shake everybody up and tries to scare them out. Then it has a run up and it tries to shake people out. It has a run up. And now the precious metal space is trying to shake things up. Obviously, it's a very big move. It looks like some damage has been done. But when we step back and look at the big picture, the stock market hasn't peaked yet. And I still believe we could see the gold and silver potentially base or even go higher going forward here. So that's where we're at. We're at this big consolidation. We just have to see how the metals are going to react. Are they going to stabilize? Are they going to build a foundation? I think this is just a crowded trade. A lot of people piled in very quickly. It was kind of headline. Everybody was like on a hair trigger to lock in profits, it felt like. And as soon as the selling kicked in, everybody just ejected. And there's a lot of people trading momentum there, meaning a lot of people will put in stops under each previous day or intraday lows. So when we start to see this sell-off, it just triggers all kinds of orders, forced orders, especially the margin calls. So to me, this is actually a pullback at this point, still within the trend. We do need to see it stabilize, or else I might be getting out the rest of my positions. We still hold a good chunk of our metals position, but right now we still got to give it the benefit of the doubt. The long-term trend is still intact. This is just an emotional, everybody jumping out the window really quick.
Silver's chart tells a familiar story: gradual advances followed by sudden collapses. This pattern reflects human behavior. Buying builds slowly as confidence grows, but selling happens all at once when fear takes control. After such a drop, markets usually need time to stabilize. Short-term bounces are common as bargain hunters step in, but sustained recovery depends on sentiment cooling and supply-demand balance returning. Damage has clearly been done, yet this alone doesn't signal a long-term top. It signals exhaustion, the market catching its breath after excess.
Yeah, that's a good point. I think time frames is very important. So I just moved back to the monthly chart of gold. And for example, gold peaked out back in 2011. It went into a bear market. traded sideways forever. 2019 is when I put on this particular physical metal position. This is when I piled in, bought lots of precious metals. I also bought some on a pullback in COVID of 2020. I bought some more. And so literally I scaled out like right up here, about 40% of my position. So there's huge gains. This is kind of the long buy and hold. I'm not holding. I do want to exit once something goes parabolic, like into this type of phase, because I don't want to go through 10 years or go through potentially like 14 years to break even again, right? So I want to catch these moves when a new bull market starts. So this was a long-term trade. I'm still in it. We might still see gold push back up, and hopefully I'll be able to trim or close the rest out at a higher price. And silver is very much the same. When we look at silver, it's got this big parabolic spike. And as you and I have talked about before, if we go way back in time, things that go straight up like to come straight back down, usually at least for half of the move. And so silver was the same. I closed out at 113 and change right up here. Now we need to let it try and figure itself out and see if it's going to quickly pop and get bought back up as an opportunity, maybe even go higher. But so these were long-term investments. Again, I purchased silver back in 2019. Now silver is much more volatile. It ended up taking much more of a hit. I added a lot of silver on the 2020 dip, the COVID dip. And so we're up, hundreds of percent to the upside. But those are long-term plays. And now I want to, trim off because I don't want to hold through potentially a long time where metals might not go higher. A lot of people think metals are just getting started. I think they're kind of coming to an end for a while, and there'll be a different asset class to take advantage of. But as you mentioned, that's a long-term play. As a short-term play, we got into silver. We caught a nice 20% move and closed out a trade somewhere back over here as a short-term trade. We got in, hit two of our targets, closed it out. And then we did the same with gold. So we trade both of them. We got into a trade over here for gold. We closed it out right over here, up here. So I do provide both, right? I have the long-term buy and hold, and we avoid multi-year bear markets. And then I have short-term trades where we just get in, hit the targets, get out as more short-term kind of gains to kind of juice up the portfolio a little bit here and there. So it really is important for people to understand what time frame you're on. I'm a buy and hold when it comes to physical metals. It's just, I believe we're at a point now where I believe we might go a long time without actually huge gains. Usually people buy the rumor, sell the news, right? It's the same we see in the stock market. People buy into a stock, it goes up, you get really good earnings, and then the stock crashes. Precious metals are the same. People are buying into precious metals, expecting the world to fall apart, all kinds of bad stuff to happen. Then the bad things are probably going to happen, and it's already priced into the metals, right? It's always, most investors are behind the curve. They're buying, anticipating when the bad news comes, it's going to send gold through the roof. Well, gold and silver have already, to me, have almost kind of priced it in for a while. And so I want to step back from a long-term view and let it figure itself out. And we could see, gold and silver flatline and pull back for a very long time. It could be several years. We don't know. And I don't want to hold something long-term at this point as an active investor if it could go sideways for a long time when it has clear signs that it looks like it's peaking.
Historically, precious metals don't peak in isolation. They often surge as equity markets approach major turning points. During previous cycles, stocks topped first, then capital rotated into gold and silver as risk assets weakened. Current charts suggest equities remain elevated but increasingly fragile. If history rhymes, metals could still see renewed strength before a broader correction unfolds. This phase, where volatility increases but trends remain unresolved, is often the most confusing for investors. It's where false signals multiply and patience becomes a strategic advantage.
Platinum definitely doesn't look too good. It had a nice breakout. It was on a nice run. And then, of course, we saw big selling in this whole space, and everybody just started to dump everything in the precious metals space. So a lot of damage has been done to the platinum chart. I did like it a few weeks ago as it was starting to break out, but not enough to get into a trade for it. I almost did, but it just didn't quite meet my criteria. So I'm not a big fan of platinum. I'm really not a big fan of precious metals at this point. I think to go back to one of your things, I think most of the easy upside money in precious metals is done. And so your question, I think you stated there was like, should people get in? What should they do here? I think obviously things have been repriced a little bit, but in my opinion, for a short-term trader, I would kind of steer clear because we might just see metals drift sideways and up very slowly, but then get hit with more selling and go into a deeper correction. If you're a long-term investor, I'd give it some time. I mean, I think it's best to let the dust settle, see where things kind of peak out. I'm not a huge fan of moving into the space right now. I mean, I'm doing the exact opposite. I'm scaling out, right? So generally, it's not ideal to move. I don't want to move in when it's at a point where everything from my perspective is saying start locking in profits and protect your capital, because the charts are pointing to, this is the type of price action that happens usually before a big reversal.
Long-term investors and short-term traders experience the same market very differently. Physical metal accumulated years ago sits comfortably in profit, even after sharp pullbacks. Short-term trades, however, demand discipline and defined exits. Bull markets regularly shake out late entrants before continuing or transitioning into consolidation. Recognizing whether you're investing for years or trading for weeks is critical. Many mistakes happen when people switch timeframes emotionally, chasing strength, then panicking on normal corrections. Trend context matters more than any single price swing.
That's a tough one. I don't think there's a whole lot that's really exciting to be at this point. Like, I think equities are a high risk play. They're still in an uptrend. We're still long stocks, but the market is definitely showing signs of weakness and fatigue. Typically, when we see gold and silver do this type of price action, it means we're very close to an economic top, something big, and that'll obviously send equities lower as well. And precious metals I'm scaling out of. I think the play to me is to protect your capital. And sometimes to do that, you just have to step aside. So move to cash till there's a new trend sorted out, to let this kind of volatility work itself out. If it builds a platform and things start to go higher again, you just jump back in and you ride the next big flag, the nice big wave to the upside in metals or stocks. But right now, I'm not a big fan of anything long-term, other than I think the US dollar could strengthen. If the economy weakens and things like that, I think the dollar will go up. So just stepping aside, moving to cash, owning the right currency, having your cash sitting in the right currency could do well. The US dollar has potential to run like 15, 17% to the upside. I mean, it doesn't probably help an American too much if but for me as an international trader, I'd much rather, instead of hold Canadian dollars, I like to hold the US dollar, so it goes up 17% against my currency. And then eventually, if the dollar peaks and the economy goes through a kind of a bit of a washing machine, I can lock in and sell US dollars and buy the cheap Canadian dollar, which will then rise in value, and the US dollar will most likely fall. So, cash is a position. It does require holding the right currency to make it actually generate returns for you. So that's kind of what I like at this point. But don't get me wrong, I'm long stocks. I'm still long precious metals. I just think the music is getting very, very close. All this price action says, there's two people left running around on one seat, and the music is about to stop.
Not every moment is meant for action. When volatility rises and trends lose clarity, stepping aside can be a position. Cash, held in the right currency, preserves optionality. In late-cycle environments, protecting gains often matters more than chasing the last upside. Precious metals may stabilize, drift, or surprise, but easy momentum appears behind us for now. Markets are signaling fatigue across asset classes. When the next clear trend forms, opportunity will return. Until then, patience isn't passive, it's strategic.